Verdict following the proceedings at KICC. That's Judge Jackton Ojwang. And of course, stay with us as our reporter Joash Onsare will be giving us subsequent bulletins later on as the news continues to trickle in. Now, moving on, Kenya's debt stands at 4.5 trillion Kenya shillings, the highest it's ever been, and this is 51.4% of the country's gross domestic product. Kenyans are under increasing financial pressure due to high unemployment, an increase in living expenses such as food, rent, utility bills, transport, and the VAT rate. As a result, it has become a challenge to manage and pay off bad debt. Most people fall into bad debt spiral because of unforeseen circumstances like the bills, divorce, expenses, job loss, not saving enough money, and one's own income not keeping up with the increased cost of living. Now, most banks are lending and firms have had to renegotiate some of the agreements because Kenyans simply are unable to make ends meet. Now, even as a famous quote by Benjamin Franklin said, rather go to bed supperless than go to bed in debt. Now, in studio with us, we have the CEO of Shika App. This is Mr. Kevin Mutiso, who will actually be demystifying to us a little bit about good debt and bad debt. But first of all, thank you so much for being in studio with us. How are you doing today?
I'm very well, thank you.
Excellent. So thank you once again for being in studio with us. Kindly just talk to us a little bit about Shika App.
Shika App was founded in 2016, and the idea was we wanted to put relevant capital and connect that to micro entrepreneurs. So my background was in private equity and lending. So I've been in lending for the last 13 years. I started off lending to businesses, then I started lending to SMEs, and now I'm doing it through the digital platform. The way we look at Shika, what we look at is we've been looking for the qualities of a micro entrepreneur. A micro-entrepreneur is somebody who runs a kiosk, a mama mboga, the tea lady, the mandazi guy, and what qualities do they have? And we figured out that one of the key things entrepreneurs usually have is high trust. So they have high trust relationships. And Kenya is one of those countries that is low trust. And low trust basically means that if I'm driving down the road and I see somebody on the side of the street fall down, more often than not as Kenyans we walk past because we don't know why, what this could be a ploy, this could be a con. Entrepreneurs have built relationships with suppliers, customers, and so if you talk to even you personally, I'm sure you have a kiosk lady who gives you debt when you don't have change. There's a guy you buy bags from who gives you debt when you don't have this, and that's what I mean by high trust. So they've built this high trust network, and we wanted to sort of lend to those people because those are the ones that usually pay back.
Right, and speaking of really getting debt from various people, there is good debt, there is bad debt, and really, is it advisable to actually get debt in order to expand your business or whatever the case may be? Because as you can see, the country is in debt and more debt, and there's more than 20 actually mobile lending apps in Kenya. So talk to me really, where do you draw the line between good debt and bad debt?
At the end of the day, debt is money, and money is trust, right? And you use money to create value. And so if the debt is taken not to create value, or is used to pay expenses, for example, I think that's where the line has been crossed. So it doesn't matter if your business only has, say, 1 million shillings in revenue per year. If you get a loan of 100 million shillings and you build value with that 100 million shillings, so you build a building or you build a software or something, that debt is good debt because it's created value, and then what you do is you pay back that debt through the repayments of the value created. And I think it's that simple. It's basically, does the debt build value or not? Yeah.
So would you advise then businesses to actually go into debt in order to expand and scale out? Or is it really possible to go into business and really expand and scale out without going into debt at all?
It usually depends on the business. If you're in the services sector and you need debt, you need to really ask yourself why. Are you acquiring talent? Is that why you need more money? Is it for fancier office? Is that a relevant priority? If you're in trade, does this debt increase your working capital? Does it increase your stock? If you're in real estate, does it mean you can have better finishings? So it depends on the business you're in, and I'd always advise entrepreneurs to always look at the use of funds before they take any debt.
All right, if you look at banks and other money lending institutions, you find that they have, know your customer policy, whereby you're really able to meet physically in person the person you're going to give the money to. So really, how do mobile lending apps and one like your own, for example, actually mitigate and be able to regulate the kind of person that's asking for the money and the credibility of them actually putting it back?
So this is what we've become really good at. I think digital lenders have become masters at KYC verification on a digital scale. And usually what happens is we seek permissions from users, and then we find third-party databases that can confirm some of the data given. For example, in Kenya, we have IPRS, which usually confirms the ID number of an individual. We have the Credit Reference Bureau, which also confirms things like phone number, full names. My name is Kevin Mutiso, but I'm sure there are 100 Kevin Mutisos. But does my phone number and my name match? So we've become really good at that. The other thing we're getting really good at is picking up digital footprints and what they look like. So the more and more times you use your phone, how you use your phone, we're able to tell whether it's you or not. And that's what KYC for digital means.
All right. Talk to me about the worthiness. How do you establish the credit worthiness of a particular person?
So I started off by saying we look for micro-entrepreneurs because the hypothesis is that entrepreneurs have created high-trust relationships and therefore understand the importance of repaying. So lending has never been about how much money goes out the door. It's about how much money comes back, right? So that's number one. Once of that hypothesis, we started looking at what characteristics do these people have. They're usually very active on M-Pesa. They're usually very active on their smartphones. You find entrepreneurs on their phone all day long talking to someone or listening to something or stuff like that. The other thing we are able to see is their cash flows, from M-Pesa. Entrepreneurs may not be the richest guys, or women in context, but the flow of funds on the M-Pesa is usually quite intense. And usually that gives us a picture. The other thing that I've noticed in the recent times, because our repayment rates have been getting better and better over time, is that there's a certain use of pay bills. So if you find micro-entrepreneurs are usually buying stuff in bulk. They prefer using pay bills. It's more efficient. It's better for accounting. So little habits like those are some of the criteria we use.
Right, and you've talked of repayment. Really, talk to me about the risk that's involved in being in this particular space and how you've been able to overcome the risks, such as perhaps not paying in time and actually following up on the payments that are supposed to be made in due time.
There are two main risks I'd think of. One is caused by the fact that we live in a low-trust society. So fraud is very high. So you have people who try to fake their numbers. They don't use their primary phones. They create fake M-Pesa messages and stuff like that. And because of that, it's been very challenging. And we had a bit of a challenge last year where we had quite some fraud. And those are some of the key lessons we learned how to manage that. The second risk we face is regulatory risk, right? So every day or every week you'll see one of the regulators making a comment about digital lending. And one of the big concerns obviously is, are we going to be shut down? And what we keep telling regulators is, just like in any other industry, there's some people who are bad eggs and there are those that are good eggs. And we actually want to be regulated to the point where we formed the Digital Lenders Association of Kenya. I sit on the board and I was a founding member. And our objective is to approach regulators like the CBK, the CMA, and tell them, look, we want to be regulated. We also do not like the bad eggs. This is what we think we should do with the bad eggs. And this is how we think we should protect the consumer, because at the end of the day, it's always about the consumer. So those are the two main risks, I'd think. It's
interesting that you talked about how you should protect the consumer. How then some of the ways that the board establishes to really protect the consumer's needs?
So one, we want to work on a database that will ensure that consumers are not over-indebted. One of the big challenges, as you can imagine, is if there are 21 loan apps, somebody borrows at 10 a.m. from one, from Shika at 2, and then from another one at 6 p.m. And that's known as loan stacking. And let me give you a real-life life example. If Lucy is given a limit of 50,000 by Shika, and she goes and borrows 50,000 from everyone else, she's gotten 500,000 shillings, right? Which is more than she could ever afford to pay. So one of the key things we're working on is forming this database so that we talk to each other in real time and say, we've given Lucy 10K at Shika. If you're somewhere else, remember we've given her 10,000 shillings. If your limit is 50, give her 40. That's number one. Number two is we want to be able to show the consumer which are the good lending apps. Because, you know, we've had rumors where people are saying that we're lending to people who want to bet. I always laugh at that sentiment because why would we want to lose money? You know, why would you want to give somebody who wants to take a bad bet or a bet? And so what we've also become good at is figuring out those consumers that want to use our money for debt, and we want to work together to avoid anyone borrowing money for consumption, but we want them to use it for building themselves. Yeah, and those are the two main things.
All right. What about the interest rates? I mean, when it comes now to repaying the loan that you might have taken, and perhaps it's for the purpose of investing or actually growing and scaling out your business, and the entrepreneur has in mind that they want to make more profits than actually the interest rates that some of the mobile lending apps put in place. So talk to me about coming up with that interest rate and really the benefits to the consumer or the end person using this particular app.
Digital lending is a 3 to 4 year old business, right? So the risk involved is unknown, right? So pricing at the moment is based off that unknown risk. I think what we need to focus on is that the consumer never had options like us before. And this is what can spur the nation's prosperity, because never has there been a time in Africa, let alone Kenya, where an individual can download an app, put his ID number and get loan to borrow and build his business. And I think that's what we need to focus on. At some point in the life cycle of the industry, interest rates will come down, and this has happened across all lending sectors since time immemorial. If you remember, I mean, I love history, and you know, in the late 1800s, early 1900s, you had the trusts in the U.S., right, and they were collapsing all over the place because there were high interest rates. I think there were 600 trusts at some point, which is quite similar to what's happening in digital lending. Today, the interest rate is 1-2% in the U.S. So at some point, the risk will finally be understood and we'll be able to price it appropriately. What we need to focus on is the consumer. The consumer has never had options like this before. How do we make the options more relevant? And that's the question we need to answer.
Right. All right, then thank you so much, Mr. Kevin Mutiso. So unfortunately, that's the only time I actually have with you. We've got another guest in studio, but that has been a little bit about good debt and bad debt, and really how far you can go when it comes to using the mobile lending apps in order to acquire the finances you need in order to scale out. Now, do stay with us as we take a short break, and follow us on all the social media platforms. That's Facebook, Twitter, and Instagram at TV47KE, and YouTube at TV47 Kenya, and follow me at Lucy_Riley.